Evening and welcome to our advanced taxation class for today. Today we will be continuing from where we stopped the last time. So, where did we stop? The last time we learned change of accounting dates, and that updated our knowledge of the three situations in which we have abnormal basis period. Okay, so just to recap on that, we said there are three C's: the commencement, the cessation, and the change of accounting date. We are going to be taking questions on that later. But for now, let's look at company income tax chargeable. So the company income chargeable to tax. Now, all the incomes here are chargeable to tax. They said Section 8 of the Companies Income Tax Act imposes tax at a particular rate. Currently, the rate is 30% upon the profits of any company accruing in. So if the profit is accruing, if it is derived from the company, if it is brought into the company or received in Nigeria, in respect of any trade. So it could be buying and selling, contracts, or business for whatever time period. So even though you are a civil servant, you are a non-resident, you are a resident, as long as you are doing the business in Nigeria or you bring the profits in Nigeria, it's going to be taxed. Then we also have rent. Then we have dividends, interest, royalties. What is dividends? Dividends arise as a result of you buying shares in a company. When you buy shares in a company, you become a shareholder. And what is the payment or the earnings for being a shareholder? You receive dividends. For interest, instead of you being a shareholder, for interest, you are lending the company. So this company is lending another company. And so the difference is they are not stakeholders. No, they are stakeholders, but they're not shareholders. They're not shareholders. You cannot call them owners of the business. You cannot say they are um, uh, creditors to the business, or you can say financiers to the business. So even though the dividends and the interest maybe is the same thing, you know, maybe you gave the company the same amount of money and they promise you the same interest or dividends, they are different things. Then we have royalties. Royalties is like what you pay for the use of another person's property. For example, let's say my lecture notes is patented and somebody is using my notes to lecture somewhere. He has to pay royalties. Or for example, look at this franchising. Franchising is also one of the call-ups from royalties. So I have a brand name, say McDonald's, and you like that name, and you use that name in your business, and you are paying me for using that name. Then there are discounts, charges, or annuities. Annuities is annual amounts that you pay or receive. Then here is any source of annual profit or gain that are not in one to 3 above. Then fees. For example, we have accountant fees, lawyers fees, management fees, dues, and allowances, whatever. So we have clothing allowance, uh, feeding allowance, recharge card allowance, all the allowances, transport allowance for whatever service. Any company entering into the agreement, whether oral or written. So don't say there is nowhere it is written. If it is oral understanding, it stands. And so all of these are chargeable to tax. Now let's go closely on dividend income. Dividend income, like I said, is income you receive when you are a shareholder of a company. Now, tax is imposed on dividend income in Section 8 of CETA. Now, the definition of dividends is as follows. In relation to a company not being in the process of being wound up, that is, it is not going on cessation, it is not going on liquidation, as long as it is still existing, not liquidating, any profit that is distributed is called dividends. Whether such profits are of a capital nature or not, including an amount equal to the nominal value of bonus shares, debentures, or securities awarded to shareholders. So any profit distributed to shareholder is dividend. So it means if there is profit after tax, so when we have profit after tax, the next thing is either you distribute the profits by way of dividends, or you retain them by retained earnings. And some companies usually do a percentage of how much to share and how much to retain. Maybe they can retain 60%, for example, for expansion, and they can decide to distribute 40%. It could be 70, 30. So this is from your profits. It's either you distribute everything, or you retain everything, or you distribute a portion and retain a portion. Using conservatism, you can distribute a little and save up more for expansion. Now, in relation to a company that is being wound up or liquidated, any profits distributed, whether in money or money's worth, other than those of a capital nature earned before or during the winding up of or liquidation, the amount to be taken as income of a company is the gross amount of the dividend and is deemed to arise on the day in which the payment becomes due. So now let's look at, however, there are provisions of CETA that exempt certain dividends from tax. So when it comes to dividends, there are some dividends that are exempt from tax. Let's look at them. These are dividends by a Nigerian company and satisfied by the issues of shares of the companies paying the dividends or shares. So any company, if a Nigerian company is giving out dividends, that dividend is here, is exempted. Okay, now you can see here again, by a Nigerian company out of any profit exempted from tax by a provision or act So once the profit is exempt from tax and you are distributing the profit by way of dividend, that dividend is also exempt from tax. Let's say, for example, you are doing pioneer business. Pioneer business is not taxed, and you are distributing the profits. That profit will also be tax-free. Out of profits chargeable to tax under the provision of the Petroleum Profit Tax, any profits that you are distributing under PPT is said to be tax-free. Now, note that dividends received from a Nigerian company are regarded as frank investment income. So, when you see me writing FII, it means Nigerian company paying dividends to another Nigerian company. Now, as this second Nigerian company is receiving this company one, and is paying it to company two, it is exempt from tax. This is because I will tell you about that. This is because the withholding tax deducted on such dividend is treated as a final. So when a company one is paying dividends to company two, the only thing it's deducting is withholding tax. So it means that gross dividends minus withholding tax equal to net dividends. Now, the net dividend is what goes to your bank. So this is the withholding dividend from source. Withholding tax is from source. So this is the gross that you're supposed to receive, but they won't pay you the gross. They will pay you the net. Let's take, for example, you have 200,000 coming. Here's 200,000. Let me check something here. Let's assume that your net was 180. 20 was removed. That means your gross is 200,000. So they are supposed to pay you 20. They remove 20. They're supposed to pay you 200. They remove 20 and they paid you 180. Now the 180 is the net. Now the thing is, even though you received 180 in your bank, when you are going to report these dividends, you report 200, meaning that this 20 that was deducted to arrive at 180, you are going to add it back as though it's never deducted. So what it means that if they give you net dividends, when showing your gross income, you must report gross dividends. because this is what is the gross. All right. Now, all of these are not too important. Let's go straight to what is important here. Payment of dividends by a Nigerian company. Nigerian dividends received by companies other than Nigerian companies. So Nigerian dividends received by a foreign company. In the case of a company which is neither a Nigerian company or engaged in a trade or business in Nigeria at any time of the year in the year of assessment, no tax shall be charged for that year in respect of any dividends received by it from a Nigerian company, apart from tax withheld, which is the withholding tax. Where any dividend is paid out of profit on which no tax payable is due or no total profit is due, or total profit which are less than the amount of dividend which is paid, the recipient of the dividend is Nigeria company or not. They said, according to subsection 1 of section 40 of CITA, such dividend is treated as the total profit for the year. Remember when we were doing dividend basis, when we were looking at basis, we looked at minimum tax, we looked at turnover tax, we look at dividend base. We said when we are paying a total, when you are paying out dividends and it is even bigger than your total profit, or if there's no total profit, it is taken as the dividend is taken as your profits. Now they said, nothing in this act shall confer on such company or on the company paying the dividend a right to repayment of tax paid by reason of the provision of this section. So all these are just legal terms. Now let's look at this question. A company with a total profit of 140,000 for 2014 assessment year paid 250,000 naira dividend to its shareholders in respect of 2013 financial statement, which form the basis of the assessment. Now they look at the solution here. The company will pay a tax of, look at this 250 that was paid. You find 30% of it. Let's look for 30% of it. Zero 0.3 times 250,000. That will give you 75,000. Now compare it with 140,000, which is total profit. 140,000 times 30% is 42. Which one of them is higher? 75 is higher. So the company will pay 75% instead of 140. Why? Because 250,000 naira dividends received is bigger than the total profit. So this is what is referred to excess dividend tax. Once you are paying dividends and once you are paying from dividends, it's also called excess dividend tax. Provision of Finance Act 2019 on excess dividend tax. Prior to the commencement of Finance Act 2019, companies are charged to tax at 30% of their dividends distribution, where such dividends exceeds the total profit for the year, as illustrated above. Notwithstanding the profits being distributed may have been taxed in prior years, exempt from tax, or taxed under a different law. So it doesn't matter whether the profit that gave rise to this dividend has been taxed. whether it has been exempt from tax, as long as you are paying dividends, you are paying dividend tax of 30%, especially if it is higher than total profit. This particularly affects holding companies on dividends received from their subsidiaries, thereby making Nigeria unattractive as a headquarters or group holding company. So a holding company, let's say GT Co is a holding company in Nigeria. And so when they receive dividends from the subsidiaries, let's say those in Ghana, those in South Africa, and all that, say Nigeria is the head office, as they are receiving these dividends, they may have been taxed in those countries, and they are coming into Nigeria, they are still being taxed. Or they may have been escaped from tax because of the company's financial or tax laws. But when it comes to Nigeria, as long as it is the total profits or it is they are sharing dividends out, it becomes taxable. So it makes Nigeria unattractive because most holding companies, they don't do anything other than finance subsidiaries. They are the ones, the parent company, they provide finance for other subsidiaries and all that. And so when they are being paid dividends, it puts them at a disadvantaged position. So the Finance Act 2019 introduced changes to limit the application of tax only to untaxed profits that are not exempt from tax. So it means that any part of the profit that has escaped tax, which is untaxed, but is not exempt from tax, that is going to be taxed. So it means that dividends received from another Nigerian company, which is frank investment income, is exempt from tax. And so that one will not be taxed. And so that makes it an attractive position. The implication of this is that the following no longer counts towards the determination of excess dividend tax. Retained earnings on which adequate taxes have been previously paid under CITA, PPT, or CGT. So now retained earnings. So it means that my profit after tax, maybe in the first year, I decide to retain everything. And I decided not to share anything for that year. Year 2, I didn't share. Year 3, maybe I've accumulated it to year 5. They're all retained earnings. And I decided to share maybe 50% on year 5. So I have already retained them in the previous year. So they are not going to be, they're not going to suffer tax anymore or dividend tax. Why? Because for you to get profit after tax, your profit had undergone tax. So profit after tax means you have passed through the tax tunnel. And these ones that survived the funnel is the profit after tax. It's not going to be taxed again. So whether you are sharing dividends from profit after tax or you are retaining them to share them later, they are not taxed. Then we have exempt profits. We said exempt profit is like profit from pioneer's business. Frank investment income. These are dividends received from another company in Nigeria. Then dividend by real estate investment company out of rental and dividend income. The year to which the profits relate is now irrelevant. It doesn't matter which year. The possibility of a company paying excess dividend is now limited. We'll see that later. Now, provisions of Finance Act 2019 on interim dividends. Now, interim dividends is the dividends you pay before the end of the period. So because you are trying to become precautionary, you pay a particular amount. Let's say the total dividend was 1 million. You decide to pay for 40% of that 1 million, which is 400,000 as interim during the year. Now, why company used to do that before is that so that they will not waste time to wait until the end of the year before they get the results of their proceeds. They can just take discretion and pay like 40%. Then, when they now prepare their financials, let's say they have taken out 40,000, 400,000, right? And they now prepare their financials and they find out that their total profit happens to be, let's say, 450,000. Now, this has prevented them from being charged dividend tax because they're only going to suffer tax on the 450. Now, because they have paid tax on the 400, they're only going to pay tax on the 50,000. That is the excess. So the company can say, okay, why don't we just take the remaining 50 towards the ending? So it becomes final dividend. So it means the one they take during the year and the one they take after the year. The one during the year is interim. When they bring it together with the one at the end of the year, it becomes final. So they are doing this interim dividends as a precaution. Now it says here that prior to Finance Act 2019, companies that paid dividends before filing its annual corporate tax returns shall be subjected to company income tax at the rate of 30% of the dividends paid, and such tax shall be paid to the Federal Inland Revenue. The tax based on the dividend shall be considered as deposit tax due from the company. So that's what I'm trying to explain. Let me make it clear again. You paid interim dividends of 400,000. Now the thing is, anytime you are paying dividends, there is a tax associated with it. So 30% of 400 is going to give me 120,000. So this is the tax you have paid. Okay. Now, it means this is a deposit tax. So this is your part payment of your tax. Now, let's assume that your total profit happens to be 500,000. Then you are now paying a tax of 30% of 500, which is going to be 150,000. Okay, so because you have deposited 120,000 from dividends, what you're only going to pay is 30,000. That is what we are saying. Now, assuming that You have paid your dividend 400. You now did your total profit happens to now be 300,000. Okay, 300,000. So what happens is that your tax is supposed to be 0.3 of 300,000, which is 900,000. 900,000 that you're supposed to pay. But because you have paid, sorry, 90,000, not 900, 90,000. So, but because you have paid 120,000, the 120,000 becomes the final. Why? This is because your dividends pay is higher than your total profits. So whatever you've paid becomes final. But if this total profit is bigger than your dividends paid, you deduct whatever you have paid from dividends, and the balance is what you will now pay. So that's how it works. Now, interest income. Interest income is any money lent by an individual or executor or trustee outside Nigeria also to a person in Nigeria, including a person who is resident or present in Nigeria at the time of the loan. And it shall be deemed to
One
be
second. Hello. Hi. Did you jump? Because you talked about prior to Finance Act 2019. You didn't tell us what happens after Finance Act.
sorry. They said prior to, okay,
You didn't, although we can see, but you didn't.
its implementation of Finance Act 2019, tax on interim dividends paid to shareholder of a company is no longer applicable. That is what I was about to say. Sorry, I jumped it. So when you collect tax on interim dividends, it is no longer applicable. So this tax you collect here, it's not going to be done that way again, considering Finance Act 2019. So what they do here is that you're only being charged on your total profits. You are not being charged tax on your dividend, except if that dividend is not exempt from tax. That is when you are now preparing your final account, they will now start checking your dividend that you have issued out. Was it from profit that was exempt or not? If it's not exempt, as they are paying, as they are calculating, you will now start calculating that one to see which you will pay. But when you are giving out dividends, you don't need to make this security deposit tax anymore. That is what they are trying to say. This security deposit, this deposit tax is no longer needed. Sorry, I skipped it. Now looking at interest, any money you lend somebody and they are paying you income from it. So there is a liability to payment in Nigeria of the interest, regardless what form the payments take or wherever the payment is made from. The interest accrues in Nigeria to a foreign company or person, regardless of what form or where the payment is made. I would like you to read some of these interest exempt from tax. Some of these things are things you have to read and remember. I'm going to a more technical place. So the Finance Act 2020, okay, let me come here. In line with the provisions of Finance Act 2020, tax relief in respect of interest payable on loans granted to companies engaged in agricultural business or trade now limited to primary production, agricultural production. So it is when they say interest on agricultural trade or business, this one here, they now from Finance Act 2020 now specified, now adjusted to primary agricultural production. That's what it's saying here. Now, Finance Act 2020 also reduced the moratorium period to qualify the interest on loan for tax exemption from 18 months to 12 months. When we say moratorium, moratorium is the period where you are not repaying the interest. Maybe because there is no activity. You took a bank loan and you are supposed to be paying every month, and you are going to be paying the interest every month. And because there is no activity or so, you have a moratorium. These are periods that you do not pay tax, you do not pay back the loan. Now, there used to be a moratorium period of 18 months whereby it is exempt from tax. But now, that moratorium is reduced to 12 months. That is what this place is saying. Okay, so you read that. Now look at provisions of FA 2019, repayment period above 7 years, moratorium not less than 2 years, tax exemption allowed 70%. Now between 5 to 7 years, not less than 18 months, 40%. Between 2 to 4 years, not less than 12 months, 10%. If the repayment period is below 2 years, there is no moratorium, there's no tax exemption. This authorized trust scheme, I would like you to read that. It's not being tested at this time. ICAN. Then this is a trustee. The trustee is a person in whom the property for a time being subjected to a trust created in the present in pursuance of the scheme. Most times, trust is created by somebody when he makes a will. Most of these trusts also is being done in connection to will. We'll talk about these later, a later topic. Then withholding tax. Withholding tax is an advance payment of tax, which is deducted at source on certain transactions and later applied where it is not final, where it is not a final tax, as tax credits in the settlement of tax liability to which the payment has suffered the deduction rates. Now, let me give you an example. Let's say this is rent payable. Gross rent payable. Now, or receivable by the landlord. Now, do not remove withholding tax of 10%. So it means 20,000 is going and 200,000 is going out, and net rent is 1.8 million. This is on net rent, and 200,000 has gone, 10%. Now, assuming this net rent is the only thing you receive in a year, right? This is also called your total profit. But let's say, let me not say this is your total profit. Let's say you now have commissions and other allowable expenses. Let's say all expenses happens to be 200,000, or let's say 300,000, right? Let's say it happens to be 300,000. That means your total profit will be 1.8 that you receive. No, you won't say 1.8 that you receive. Never. When you want to report your rent, you report it as gross. You will say 2 million, that is a gross, minus 300,000, which is allowable expense, giving you 1.7 million. So this 1.7 million is your total profit. Now look for 30% of it. How much would that be? So let's say 1.7 million times okay, I was explaining something. Now, because you have charged, you have been charged 500,000, you have been charged 500,000. Why is my mouse doing like this? Just a moment. So you have been charged 500,000 as your total tax because you see here, gross income was used and this is your expenses, 500,000. The 200,000 that you suffered as a withholding tax will now be deducted because it was an advance payment. So you now have to pay 310,000. So that is what it says here. Now, in some cases, this 200,000 becomes final tax, meaning that this is not subjected to further tax. Like in the case of dividend, if it was dividend that is franked investment income, and you are paying 2 million, and they take away 200,000, and the net is 180, you will not suffer another tax because this 200,000 will become the final tax on dividends income. That's what we are saying. Now, arising from this definition are the following peculiarities. Withholding tax is a deduction at source, which gives the taxpayer no option whether to pay it or not. So it means you must deduct. If you have the obligation to deduct, you must deduct. The taxpayer who is receiving the money, which is the landlord, has no option than to suffer the tax. Secondly, withholding tax is an advance payment against the income tax to be paid later. It is not a separate tax, just like VAT. No, VAT is a separate tax. Withholding tax is not. Withholding tax is an advance payment of income tax and cannot be used later as credit for any other tax, such as education tax or value-added tax. So your withholding tax is advance of your CIT. So you cannot use it to, to clear education tax or to clear VAT. It is only meant for that purpose. Let's say, for example, you have some bills. Let's say you are having ICAN bills to pay, maybe CITM bills and others. And you now decide to pay part of your ICAN bill, and they now give you a credit note. That part you paid cannot be used. That credit note cannot be used to go and say, okay, I have made deposits. I'll use it to clear CITM. No. It's only that advance payment of the one you paid that it is being used. So withholding tax is an advance payment of CIT and cannot be used to offset education tax or VAT. Some withholding taxes are regarded as final taxes. I mentioned that. Where this is so, the income from which they have been deducted can no longer be brought into account for tax purposes. So it means that you have deducted it from, let's say, dividends. You cannot bring the dividends again for tax purposes. It means you have to exempt it from taxes. Withholding tax is to be utilized as credit for the income tax liability of the year to which the income relates in the first instance. So it means if you pay withholding tax for 2023, it is 2023 that you are going to use the withholding tax credit note to offset. Now, it's possible that you may have paid more withholding tax than the total tax itself that you're supposed to pay. Let's say your withholding tax happens to be 200,000, and your tax that you're supposed to pay, it happens to be 150. What it means is that you have paid 50,000 more in withholding tax than the tax itself. The 50,000 is now an excess. Any excess on unutilized carry toward future years. Withholding tax as a collection device was introduced in a limited form by the CETA and later expanded in terms of coverage. Okay, so you read all of that. Withholding taxes, rates, remittance, and authorities. Taxes to be withheld from corporate bodies and individuals at the rate listed in the table below and remitted to the tax authority within 30 days in the case of individuals and 21 days in the case of companies. Now, they said Peter provides a fine of 5,000 naira or 10%, whichever is higher. But now, whichever is higher, you pay 5,000 naira or 10% of the tax due, whichever is higher. Now, look at this thing now. Now, take notes. Let me put a caveat here. Beginning January 1, 2025, these rates no longer apply. There is a new withholding tax regulation. And for the sake of your knowledge, I will advise you to read the new withholding tax regulation for your knowledge sake. It will not affect your exam. What we are saying here does not hold in 2025, for it to be used in your exam. All right. Now look at the company rates, look at the individual rates. I want you to note something. There are some taxes that both individual and companies are 10%. For example, there are three. I call them RODI, or I call them DIRO, or call them DIRO. So these are the DIROs: dividends, interest, and rent. I call them DIRO or ROID. I call them director, DIRO, dividend, interest, rent. Whether you are company or whether you are individual, it's 10%. And these are what we call we call them investment income. Investment income. Investment income. And it's also called unearned income. Unearned income. Unearned income. Now, this unearned income is different from business income in the sense that you can sit down without working and you are receiving rent. Sit down without working, you receive dividends. Sit down without working, you receive rent. Now, there are some that both individuals and companies are 5%. Like in the case of construction and contract of supply, especially contract of supply. Contract of supply. Both individuals and companies are 5%. In some construction, you have 2.5. Now, after that, every other thing apart from director's fees, every other thing is 10% for company, 5% for individuals. Be it commission, be it consultancy services, technical services, management service. For company, it's 10%, individual, it is 5%. Royalty is the same thing. That's the way to know it. But director's fees is only 10% for individual. So when it is director's fees, why is it dash for company? A company cannot be a director. So when they say, who is the director of a company? You now mention another company's name. No. But a company can be a shareholder to another company. A company cannot be a director. So you cannot be paying director's fees to a company, but you have to pay director's fees to an individual. So the DIRO, see why I call it DIRO? DIRO, the individuals are getting 10%. Now come and add director's fees. It's still DIRO, right? In spelling. Individual also gets 10%. But the company does not get anything here. Then construction and contracts, I call them double C. Both of them get 5%. Then every other thing, company gets 10, individual gets 5. And that's a way to remember them. All right. Comments. Deductions from companies are payable to FIROS. So if you are deducting from companies, you are paying to FIROS, while that of individuals are paid to State Board of Internal Revenue. Why? Because withholding tax is an advance of your personal income tax for individuals. For company, it's an advance of your company income tax. And FIRS are the ones receiving the company income tax. So if you are paying advance, which is withholding tax, you need to pay to them. So the same thing with the states. Deductions from individuals are payable to the FIROS or FCTIROS when they are made from residents of the FCT, Abuja, members of the armed forces, and all that. Withholding tax on dividends, interest and rents, which is DIRO, and royalties when suffered by non-residents are final tax. Also, with effect from January 1996, withholding tax on interest and dividends are final tax when suffered by Nigerians. So, what we are saying here is these two are withholding tax final tax equal to final. Now, for residents and non-residents. Something is happening to my pen. Non-residents. Non-residents. Whereas royalty is final I will say final for non-resident. Non-resident. Something is happening to my pen. All right, so that's it. Provisions of Finance Act on withholding tax on construction activities. We said Section 81 of CETA, that is deduction of tax as such, was amended by Finance Act 2019 to reduce withholding tax to 2.5% for the following construction activities. If it is road, bridges, buildings, power plants, these are the ones that will suffer 2.5. Every other construction will get 5%. Now, credit notes. As soon as payment is made to the bank and evidence provided to the FIRS, the withholding tax section of the FIRS will issue a credit note in favor of the beneficiaries contained in the schedule. Now, look at what it means. Let's say goal getter, I'll call it goal getter GGPC. I am the one that is paying. I am paying to different people. Now, I provided a schedule for withholding tax, and I list all the people that I paid that are my vendors. Let's say I list Zenith Bank. Zenith Bank is one of the vendors. Let's say I list FCA. It's another Zenith, it's another vendor. And let's say I list Wise and ICAN. Something is happening to my pen. And I list ICAN. These are the people that I deduct their withholding tax, and they are sufferers of withholding tax. Now, as I pay the withholding tax to the FRS, the FRS, let's assume all these are companies. The FRS will issue a withholding tax credit note that will carry, okay, so it will have 1, 2, 3, 4. They will have 4 withholding tax credit notes because I have 4 names here that will carry the names of all these people. Now, this withholding tax credit note will not be given to them, to be given to GGPC. Now, this GGPC is the collection agent. So because this GGPC collects this withholding tax, so it is registered as a collection agent. And so these credit notes are to be forwarded by the collection agent to the beneficiaries who suffer the deduction. This is because the credit note is to be used by these beneficiaries in claiming their various taxes at their various tax offices where their files are domiciled. It is important to emphasize that the presentation of a letter from the collector agent showing that the taxpayer has suffered deduction is not fair enough to give credit. So it means that when GGPC collects the withholding tax from Zenith, FC, and Wise, and ICAN, and GGPC now issued them a letter saying that, okay, this letter shows that I have collected withholding tax from you and all that. Fine, that is showing you that I am indebted to you. But bringing that letter by Zenith Bank or FCA and showing it to FIRS that look, I have suffered the withholding tax, that letter is not enough. What FIRS is looking out for is, do you have a credit note? Do you? So sometimes the GGPC may deduct and may not remit. And when GGPC has not remitted, what happens? It means that FIRS will not issue credit notes. So because I gave you a letter showing that I have deducted, the fact that FIRS has not issued credit notes in your favor, you cannot apply it. Especially in this digital world where everything is being automated. Normally, everything is online. The credit note is given online and you can be applied on your portal. Okay. I think part of the tax reforms that was, being promoted, but has not been passed on to law, was that when people are deducting withholding tax, if you provide evidence, apart from the withholding tax credit note, you provide evidence that you suffer withholding tax, the government is going to grant you the withholding tax. And GGPC who collects the withholding tax, if he didn't come forward, they will charge him double. I'm going to charge him double because he didn't come forward. That's part of the things that was being put forward to prevent people from taking government's money and not, paying it. But we're not talking about the new withholding tax regulation. Let's stick to what is here, because this is what will make you pass now. Now, there's something called withholding VAT. What is withholding VAT? Now, government agencies, MDEs, and even oil sectors, and now some telecommunications like MTN and Airtel. These are the two that have joined these people, are doing something called withholding VAT. What is withholding VAT? I will get to it. Now, normally, if you go to a ministry and you do a contract of 1 million naira, this is what you are supposed to pay. This is what you are supposed to get from government. This is 1 million naira. That is your revenue. I hope you know the meaning of revenue. This is your raw revenue without any taxes attached to it. You then decide to add VAT. VAT, which is 7.5%. VAT, which is 7.5%. So what is 7.5% of 1 million? Let's calculate. 1 million times 7.5 divided by 100. That will give you 75,000. Okay. So this is 75,000. It's happening. Something is happening tonight. So 75,000 is what you're supposed to add. So that means you have 1,075,000 that the government is supposed to pay you. That's the ministry is supposed to pay you 1,075,000. Sorry, the class is a bit slow because of the way my pen is moving. Now, when the government wants to pay you, they will remove withholding tax. So let's say minus withholding tax. Now, this is a contract for supply. We say it's 5%. Now, this 5% is on your revenue, not on this. It's on your revenue. 5% is 50,000. So 5% is on 50,000. So instead of giving you 1075, it's supposed to be 1025. This is what is supposed to come to you. Now, what does it mean? It means you have collected your VAT or you have suffered withholding tax. You know, those days when VAT was 5% and withholding tax was 5%, both of them cancel out and it becomes 1 million. But now, look at what they will do. Instead of giving you 75%, instead of giving you this 75,000, they are going to withhold it from you. So yeah, in this case, they are giving you the money. But instead of giving you, so they are going to deduct 50,000. They'll come here again and deduct the 75,000. So you end up 950,000. Is what you are getting. So it means here, government has taken this withholding tax, this VAT, I mean, and they have taken this withholding tax. Now, normally, this withholding tax is supposed to be withheld, right? Because that's a law. But VAT, you are a VAT collection agent. You are supposed to be the one to collect this VAT. But because you are dealing with ministry, they will collect it on your behalf so that you do not evade tax. So they are withholding this VAT from you. So it is called withholding VAT. So when you are suffering that, there is a place where you file withholding VAT. Now, all of these people act as agents in the deduction of withholding tax from contract sum payable to their contractors. That's withholding tax, which is like this 50,000. Also act as agents in the collection of VAT from their contractors when they are paid. This is also called withholding VAT, which is this 75. Normally, they're supposed to pay out this 75, but they will collect it. Instead of paying you 1,025,000, they are paying you 950. It means they have collected VAT and collected withholding tax. So that VAT they collect is called withholding VAT. Advanced income tax payments. When a company wishes to pay dividends, CITA Section 31, subsection 7 provides that tax at a standard company rate is paid on the amount of the dividend. We will not be taking that again because it's the same thing as the deposit tax we have been talking about. Illustration 4.10. Let's look at what it says here. A company is paying a dividend amounting to 500,000 in respect of the year ended 31st December 2013. And now it is payable. The dividend is payable on June 15, 2014. The total profit of the company for the year was 800,000 after capital allowances. So this is the total profit, and this is the dividend that they are paying. The company intends to file its self-assessment by the due date of June 30. Now, when the dividend tax is being used, I will said before, the company will pay 30% of 500,000, which is 150. They will pay it in the beginning when they want to pay this dividend. Thereafter, the dividends of 500 can be paid to their shareholders. Now, when the company is assessing itself to tax, the company has identified that 800,000 is the total profit, right? Out of which 30% is 240,000. This is your tax you're supposed to have paid. But because you have paid 150 before as dividend tax, the balance you are going to be paying is 90. Now, under the self-assessment scheme, companies are not expected to wait to receive the assessment from the revenue before settling their respective tax liability. They are going to do this calculation and they will only pay this 90,000. Now, they said exemptions of sale in the ordinary course of business. I will not be taking that for now. Most of these are readable things here. Let me see the one that will contain calculation so that we can dive straight to that. And some of these readable things are repeated. Go down, down, and down. You see most of these things here. Okay. Now, Finance Act, okay, provision of Finance Act on classification of companies and tax rates. The position of company income tax prior to the commencement of Finance Act is that all companies are liable to the same company income tax of 30%, with the exemption of small businesses. And a small business are businesses whose turnover does not exceed 1 million naira. For those ones, they are taxed at 20%. But now the Finance Act has expanded it that no, a small business, we will not be talking about 1 million naira. We'll be talking about annual gross turnover of 25 million or less, and it's 0%. Now you see this 20% that we're using to charge small business, they moved it to medium-sized company, which is greater than 25 million, but less than 100 million. Then 30% is for annual turnover of 100 million and above. So you should know this table. This is one very important table, although they will give you the exam, but most of our calculations will be influenced by this table. Now, implication of classification of Nigerian companies. Small businesses are required to register for tax. So you have to get your FIROS team, perhaps your State Internal Board of Revenue team. You are still going to prepare audited financial statements. Although for small businesses, you have management accounts without having audited financial statements, you can still file it because you're not obligated to hire an auditor. You will still file your tax returns when due. Small companies are no longer liable to withholding tax. Why? Because withholding tax is an advance payment of their tax. And if a small company has 0%, Why will he be taking advance payment for it? So once you can prove that you are a small company, you will no longer suffer withholding tax. So that's how this chapter has ended. We've seen a lot of things on rent, dividend, royalty, and we'll be looking at some questions, and I'll be telling you certain things about how to, solve some of these questions that has to do with these unearned incomes, that has to do with dividends, interest, and rent. I call them DIRO, and including royalty, so DIRR. All right. Let's look at one question here. Question 2 here. Question 3. Oron Limited was incorporated in 2018 and commenced business on October 1, 2019. The first set of financial statements prepared by the company covered a period of 15 months from October 1 to December 31st, 2020, and the adjusted profit was 3 million. Required, ascertain the relevant basis period and the assessable profit for the relevant years. Let's see how it was answered here. So you see here, because it started business in 2019. It is not in 2020 year of assessment. So this 2019 falls in the old regime. We solved this question before. 2020, we have nothing. And 2021 will have been in the new regime. We solved this particular question before. So let's not talk about it much. So what we'll be doing now is we'll be looking for ICAN pass question that we can use to solve some of our problem. So hold on a moment while I get ICAN pass question. All right, we have a question from May 2024 Pathfinder for Skills, question 2. Adidas Nigeria Limited has been in business for so many years. The company is into supply of furniture, fixtures, and fittings. Since the date of commencement of business to the accounting year ended 31st October 2018. So this date is important. Since that time up to here, it has posted reasonable profit. In the year 2019, a competitor, ABC, was able to introduce a brand furniture into the market, which boosted the sales of the company. Unfortunately, this has an adverse effect on the gross turnover of Adidas Nigeria. Despite concerted efforts made by Adidas Nigeria Limited to compete favorably with ABC, its fortunes dwindled. To allow for capital injection, the directors of Adidas Nigeria Limited decided on February 1, 2020, to change its accounting date in line with one of its foreign partners. The board therefore decided that accounting year to be changed to 31st December every year. So what do we know? This is the new accounting year. This is the old accounting date. This is the new accounting. So the old date is October 31st. New date is December 31st. Now they said, when did this happen? They said decided on February 1, 2020 to change. So it means that instead of bringing the account to October 31st, 2020, they will be bringing it to December 31st, 2020. What does that mean? The first year of change is year of assessment 2021. All right. We are provided with the following information: adjusted profits, this is what they had up to October 31st. Then they now brought 14 months. They now brought another one. We now have a gross turnover. Year ended. Look at the gross turnover. Now this gross turnover is for the purpose of ascertaining whether they are going to pay tax or not. Look at the capital allowance is 2020, 2021, 2022. Okay. I think in this question, ICAN wants to use 2020 as the first year of change. In this question, ICAN wants to use 2020 as the first year of change. I don't agree with that, but I think that is what ICAN is saying here. Because they made this decision in February 1, 2020 to bring, okay, so it means that, okay, what they are saying here is 2020 is the year that decision was made. I tend to agree with them. So it means that for that year of assessment, this is the year that they agreed that they have to change. So 2020 is the first year of assessment. So we have year 1, year 2, and year 3.
Sorry, I'm sorry, please. I'm sorry. What are we going with? They decided to change it in
Oh, I'm hearing you.
2020. Hello? Can you hear
I'm hearing.
me? So it
I can,
was decided to be changed to 2020. So it's going to be the first year is going to be from February to December 2020. But the year of assessment is they would be assessing the profit in 2021.
no. That was what I was thinking, and I changed it.
And I know you are changing, but why? But because we're doing it on
I want to
preceding year
explain.
basis.
I want to explain. They decided that they take that decision in February 1. They could have taken it in January. They could have taken it any month. But they've decided that going forward in this 2020 February 1, this decision is being made
Okay.
that our accounting year will end in 31st December. So it means now that in this year 2020, they are going to implement the change. That's what they are saying. So it means that normally they are supposed to, in 2020, they are supposed to treat an account ending in October 31st, 2019. But they are now saying that no, we are going to, if affects change of accounting year from October to December, beginning this 2020 year of assessment. They made that decision in February 1. So it means that the first year of change is the 2020 that they took that decision. That means any account is going to be treated on preceding year basis.
Yeah.
Instead of ending it in October 31st, 2019, they are going to decide to change it to December 31st, 2019. That is what they are saying. We have identified the first year of change. We have 2 years will follow 2021 and 2022. Another thing from this question that will help you to note is that look at the capital allowances. They give you 2020, 2021, 2022. They also assist you, because capital allowance are always given a year of assessment. So now,
Sorry, please, I'm confused here. Okay, so say for example, they did not change the dates and it is still from October 2019 to sorry, and it still ends from, it started from November 2019 to October 2020. Normally, they didn't change the date.
if they
The
didn't, if they
one,
didn't make that
sorry, let
decision,
me just let me get my question right. If they didn't change the dates like that, and they didn't make that decision, and we're doing the year of assessment is going to be in 2021 because we'll be doing it's based on preceding year base. It's going to be from November 2019 to October 2020, right?
I didn't get your question because of
I'm
network.
saying that if there was no change that year, right? Say they didn't change the date, they didn't make a decision to change the date in February. Normally, it will still run from October to no to I'm sorry, from November to October 31st, right?
Yes, that means that is
Okay,
how
that
it's
means
running.
the year of sorry. So that tax will be the year of the year we'll be assessing the tax will be in 2021. So 2021 period base will be from November 2019 to October 2020, right?
Continue. I'm yet to get your question. You are
No, no,
making,
I'm trying to understand. That is it, right? So
yes.
now because from what we did the last time that in class. They made a change in 2020. Yeah, so that's the year of change. So the subsequent 2 years would be added, like 2021, 2022. But the years we'll be assessing them, it's going to be the following year. It's going to be year of assessment 2021, 2022, 2023.
I said that for you to identify the year the change began. That is your
Yeah, I'm
first
talking
one.
about their year of as that the first year will be
Now,
2020, yes. But the
everything
year
is
of
assessed on
assessment.
everything is assessed on preceding year basis. Everything is assessed on preceding year.
So
So if
then the year of assessment will be 2021 for the first one, right?
no, yeah, still
Okay,
get
if you are saying that it is actual, if we are doing
down.
okay,
Now, calm down, calm down, calm down, calm down. This is the year, the first year. It means the account that is going to be assessed on this year should end in 2019.
that's what I'm trying to say.
Not forget about this 20 year end decision. It's just like saying the date that Finance Act 2029, it came into effect February 1, 2020. And what happened on February 1, 2020? They made it that 2020 will be the tax year that Finance Act is going to be implemented. And it means that any account ending in 2019, which is the basis period ending in 2019, falls under Finance Act 2020, Finance Act 2019. So now we are saying here that This February is not an account year end. It is the date the decision was taken that from this year, we are changing our accounting date. That's why I put it that from this year, we are changing our accounting date. Unlike the one we solved before, they gave us accounts, and you can see how the change occurred. Here, they are giving us in words. They are giving us word problem. Now look at here. They said, since the date of commencement to account year ending in 31st October 2018, it had posted reasonable profit. Remember, I put here old. This is where the old date ended. In the year 2019, the competitor started. But they now said on 2020, this year, we are changing our dates. What it means is that the first year of our changing of date will start from 2020. You have identified the year of change, the first year. If they didn't use word sentence and they brought an account, you would have used that method I told you in class when we solved the other one. And I told you another thing. Another thing that could also help you is look at capital allowances. They are always stated a year of assessment. And you need 3 years of assessment, and they have given you these 3 years. That is another thing that will help you in the exam. So this capital allowance also gives us a hint that this rationale is correct. So let's solve it in our blank book here. We'll call this Q Pathfinder. May 2024. Question number what? Oh, sorry. Question number 2. Question number 2. And the name of the company is Adidas. Adidas Nigeria Limited. Okay. Now, we are told that the old date and if we want to do a change of accounting date, it required for the relevant assessment years, compute the assessable profits, compute the company income tax liability, ignore minimum tax. So we'll come here. Computation of assessable and taxable profits. Is it profit we asked? Okay, accessible and taxable profits and tax liabilities for years of assessment 2020 to 2022. So that's what we will do. So since these are the relevant ones, we will now say based on old accounting dates, which is October 31. Okay, so this is going to be our Naira sign. You have two Naira sign. So start. This is your year of assessment, 2020. Your basis period will be November 1, 2018 to October 31, 2019. That's your basis period. Then we are given accessible profits, 224,500,000. 24,500,000. So you come here, accessible profits, 24,500,000. Okay. Now the next thing to do here is, because they are into furniture fixing, they are not into agriculture, they are capital allowances. Okay, these are their capital allowances. Supposed to be two-third, but they have given you the capital allowance. Not talking about capital allowances. The thing I wanted to do in capital allowances, I will not do it here because that's not the topic. Now, capital allowance is 850. So I will say less capital allowance. That's 850,000. So how do we calculate that? 20. Wow. Let me get that calculator. Oh God.
That's should I give you the figure? Okay.
Give us the figure.
23,650,000.
Okay.
It's just so that we don't.
Okay, 23,650. Okay.
Yeah.
Wow. $23,650,000. Now this is going to be your total profits. Now your tax, okay, let's say this is CIT, for this company. At how many percent? The percentage to use, because this is 2020, it comes under Finance Act
Oh, no, it's
2019.
to be 30.
It should be 30? No, it should not be 30. Can you see here? Gross turnover is 49 million. So it is more than
Okay, more than 25.
5 million. So
Yeah.
you're going to use how much? You're going to use 20%.
Okay. We'll not cram that deep.
Yeah. Assuming this was 24 million, you're going to be zero.
Zero.
An
Yeah.
exam, maybe the first year might be zero, second year might be 20%, third year might be 30%. So, but look at this thing. And that's why the reason they give you gross turnover is for you to determine the tax rate, 20%. So please, can you help me look for 20% of this and give me the value? Because I find out that when I go to calculator and come back, this thing will give me
For um 4,730,000. 730,000.
4,730,000 and what again? That's all.
That's all, yeah.
So this is your tax liability, but it is not cast on stone. It is not cast on stone. Okay. The next thing to do here is year of assessment 2021. And that should be from November 1, 2019 to 31st October.
Sorry. Sorry, I just wanted to say something. So, the Finance Act 2020, right?
2019.
Sorry, 2019. That's from 2020. But I
Yeah.
thought any year that ends in 2019, we would not follow the Finance Act implementation, do we?
2020 year of assessment.
Yeah. So
We are using
even despite the
preceding,
fact that the basis
we are using
period ends in
we use
2019,
preceding year basis. If you use preceding year basis and
yeah.
we are at 2020, when should the account end?
No, I know. I'm just asking a question. So despite the fact that 2019 is when it ends, because you said something earlier that we will forget 2019. I'm trying to just get it very clear. So despite the fact that the account ended in 2019 and the basis period ended in 2019, we still go with the rule of the Finance Act 2019, right?
Long as we are considering year of assessment 2020,
Okay, but
finance
if it
act has begun.
okay,
You cannot
so
use normal, you cannot use actual year basis. It must be preceding year basis, meaning
yeah,
that it has to end in 2019.
so we go with that rule.
Yes.
Okay, that's what. Sorry.
If a company started in 2019, it's a different thing.
Okay.
The company started in 2019. The company must use the old rule. But this is not a company starting in 2019. This is company changing its accounting date in the year 2020, and their basis period end in 2019. In the first question we did before, the company started in 2019 and made something. So we use the old rule that use actual year basis. But in this
Mhm.
one now, the company, the year we are considering is 2020, and
Okay.
it's going to be on preceding year basis. And preceding year basis shows that it must have an accounting date ending in 2019. So
Mm-hmm.
go to 2021, it must have an account ending in 2020, October 2020. So how do we get the assessable profit? Assessable profit. The assessable profit is going to be done by workings. Now, did you see here that this period is 14 months, starting from November 1 down to December? We are going to take only 12 months out of these 14 months, 38,200. We are going to say
12
12
over 15.
over 14. Please be doing it your calculator. 38,400. 38,400. Yes, let me see. 38,200. 38,200. So you can do it to your calculator and give me the figure.
Sorry.
Others in the house can participate and drop figures.
Okay, so that's going to be 30,560,000.
Okay.
Ah, no, sorry. Sorry. I did 12 over 15 instead of 12 over 14. I'm so sorry.
Thank
Times
you. 14.
38, 200, 12 over 'cause it's been a long time I press calculator. Okay, so that's 32,742
2, 7, 4,
42,857
8, 5, 7. Okay.
dot 14 decimal
So
point
we
one
have
four, but it's less than 5.
it's 2, 5, 8, 5, 7. That's fine. Then we have your capital allowance. Wow. Why is this? Ah, wow. Capital allowance. Capital allowance was given to us here, 720. So you are going to remove 720 here. And when you remove 720, what do you have?
So,
You're going
we have
to
320, 22857.
320. It's like 320 million.
No,
Call
no,
it.
sorry. 32 million,
Yeah.
22,000, and 20, yeah, 22, then
So
857.
this is going to be your total profit.
Yeah.
Total profit. Then your tax at, you now check. What is going to be our tax here?
I don't have the table of head.
We said the table here, we said before. Look at the table.
Would they give the table in the question?
I will give you the table in the question. Let's look at it.
Oh, okay.
Look at the table so that you will know that it will give you the question, table in the question. Are you seeing Nigerian tax rates?
Oh, okay, yeah.
Are you seeing it?
Yeah. Okay.
And which company is large? Which one is medium? Which one is small? You're not the one to find out. You said large is 100 million and above.
Mm-hmm.
Medium is between, it's above 25 million, but
Less than 100 million, yeah.
while small company is from
Less
0.
than 25, it's 25 million. Okay.
So what tax rate are we going to use now?
20.
20%, right?
Yeah.
Okay. So, but now, kindly note that this period is a 14-month period. So I want us to do something for me here. I want you to do 12
over
over
14.
14 times this. Let's see.
Okay. 1 to 5. I think Patricia is asleep. Plus,
Hi, I'm not asleep, but I'm awake.
Yeah. I know.
okay, I thought you were asleep. So that's 64 million.
Okay. No need to talk further.
Yeah, so
It's
it's 20.
20%. We
Yeah.
take it down here at 20%. Because when I say tax, we know it's CIT.
Yeah.
CIT. So can you find the 20% of this figure? And let me get them down here.
Yeah. 6 million
6 million
404 4
404,000
4 4 404 4
404,000
571.4, but that's relevant.
Okay, so that's
Yeah.
for 2021. Then for year of assessments 2022, which is going to be from November 1, 2020 to 31st October 2021. Then we have our assessable profit. Assessable profit here is going to be, we're going to take here 2 over 14. Let me just write it down here. Going to be, did I do workings here? Yes, I did the workings here. So I'll come here, 2 over 14 times, what's that figure there? 38,200. 38,200 plus, we have taken 2 now, so we remain 10. 10 over 12 of 44,100. That's a way I showed us how to do this calculation. Open your
Yeah.
bracket, 2 over 14 times this one, close the bracket, plus, open the bracket again.
Yeah, so that's 42 million
Everything is 42 million.
207,142.9, so say 143.
Okay. That's your accessible profit. Then your capital allowance. Capital allowance is going to be 600.
600.
So that's going to be 600. You less it,
That'll be 41,607,71483.
607. All right. So the tax, which is CIT, is at what percent? Okay, so what you are going to do for me now,
Mm,
we are
That's
going
going to
to
be at 30%.
check 2 over 14 of this plus 10 over 12 of this. So this one, 2 over 14, 2 over 14 And here is 10 over 12. Let's see their revenue or their gross turnover.
Okay, so the first one is 10,742.
So I want you to add them together.
Okay, I'm just put this down. So.
You would have done it the way you did that one.
Yeah, that's a mistake. Times 101, 300. Yeah, so it's like 95,159,959. So that's 20 less than 100 million.
Yes. So that is how you do it now at 20%. So look for 20% of this. 20% of this.
It's 8,321,428,429.
That's very good. Now, having done that, what you will now do is you will now say
Some
sum of accessible profits. Now say your assessment, accessible profits. So this is 2020, 2021, and 2022. So in 2021, we're already seeing it 42,70207, 42,207,142. 42,207,142. I hope I got it correct. 42,207,143. Let's check that of 2021. 32,472,857. Four seven two eight five seven. Yes. And let's check that of 2021. 24,500. So let's add them together. Can you add them for me?
Yeah, that's what am I doing? 9918. Yeah, that's 99,180,000.
180,000 complete.
Yes.
Good. Now that's for the old dates. Then you go down and say based on new account dates, which is December 31st. So we have our year of assessment 20 from January 1, 2019 to 31st December 2019. So January 1, 2019. This account started from November 1, 2018. So January 1, 2019 is here. From January to October is 10 months. So we are taking 10 over 12 here and 2 over 14 here. So can you do it and get one figure for me?
Okay.
Because the November and December 2019 is here.
That's 25 million
Okay, hold on.
873
873
809
809.
0.5.
810.
So yeah, 810.
810. Okay, let me write it down here. 25,873,810. I should have done,
That's adjusted. Yeah.
I've done the workings. Yeah. Adjusted profits. I would have said this is going to be
10 over 12
10 over 12
times 24,500
or 500 plus
plus
2 over 14,
times 38
38,
200.
200.
Yep.
All right. Then capital allowance. How much is that again? 850. 850. What
That's
would that
25 25 million 23,810.
be?
3,810.
So this is your total profits. Then your CIT at CIT at. So you do the same thing. Here is going to
20.
be 10 over 12. Here is going to be 2 over 14. Let's see what you get.
Okay.
2%. Ten over 12 and 9, 100, 200.
Yes,
Plus,
that's 51 million, so that's 20%.
Times 2 at 20%. So look for 20%. And let's see.
And 5 million,
Okay,
4,762.
4,000
762.
for lies.
Sorry?
Call it again.
Yes, that's 5004.
Okay,
Yeah,
all right,
762.
all right. Then the next one is year of assessment 2021. And that's going to be January 1, 2020 to 31st December 2020. The assessable profits what is it going to be? We are now taking 12 over 14 of this. That's all.
Okay, yeah. 12 divided. Yeah, that's 64 million. So that's
64 million.
20% as well, yeah.
Exactly 64 million.
64 million. Oh, sorry. 64 million 457
457,
571.
5, okay, 5,
571.
5, 7. What would have just done here is 12 over 14 times what?
Times 75, 200, 500.
What did you call?
75, 200, 500.
It's this. I'm
Eh?
coming. I want to write this work is 38,
Oh,
200.
oh, no, sorry. No wonder I was saying 20%. That's wrong. Sorry. I did. No wonder I was thinking we're already doing the turnover, trying to ascertain the tax percent. I now remember why I kept saying 20%. So let me do the calculation again.
Okay, do it again. We have done it before.
Yeah, so that's 32 million.
32 million,
Yeah. 742.
32 million, 742,
857. Oh,
7.
you have the answers with you there.
No, I've seen it before. That's what we did before.
Oh,
Okay.
okay.
Then we have capital allowance.
Yeah.
How much is the capital allowance? 720. 7,
Minus 720.
and that would be
3
2,
32
0,
thousand 22,857.
5, 7.
Yeah.
That's the total profit.
Mm-hmm.
And what is going to be our tax?
It's going to be at
20%.
20% because I know I did 12 over.
At 20%. What would that be?
That's 6 million
6 million,
404 571.
404, 5, 6.
571.
We did that before.
Yeah, it looks like the same.
We have our year of assessment 2022. And it will be January 1, 21 to 31st December 21. Accessible profits straight 44,100.
Mm-hmm.
44,100
Minus capital allowance.
allowance. How much is that? 600.
That's for 3,500,000.
So this is your total profits. Then CIT at 30%. Find 30% of this. You know why I'm using 30% now? Because
Because the year ended is 1 year.
the gross turnover is this, over
Yeah.
100 million. You get me? It's because this gross turnover is over 100 million. That's why I'm
Yeah,
using.
yeah.
So look for 30% of this. Let's see.
That's 13,050,000 naira.
All right. I will now say sum of accessible profits new dates. This is the year of assessment. Is the accessible profit 2020, 2021, 2022. So for 2021, 2022 is just straight 44,100. 44,100. This one was 32,427,857. Am I correct? 32,742,857. 32,742. While the other one, 25,873,810.
That's 102 million. 102,716,667.
Because,
102,716,667.
I don't have control over my mouse.
Sorry?
I don't have control over my mouse. Hold on.
Oh, okay.
Ah, so 102 million,
Yeah, 716,000.
716,
Yeah, 67.
667. So between this one and the old, which one is higher?
What's the old one? The new
99.
date is higher.
So the new is higher. So it means that this is what we are going to present.
As the
You
year
now
of
say,
assess. Yeah.
and based on the new.
Good.
I had to take it like this for education purposes. But in the exam, what you will do is this. You will do old basis. You only look for the accessible profit. At this time, you don't need to even put capital allowance and your tax. Just look for accessible profits for the first year, accessible profit for the second year, accessible profit for the third year, and you simply add them. Then you go to the new basis, do the same thing, accessible profits only. When you have ascertained that this 102 is higher, you now come down and start doing this thing in details. So this would have saving us time that we are taking to do both of them. That is for exam purpose. But I had to do it this way for lecture purpose so that you will see how it is being done for lecture. So far, so good. We've looked at the investment income, dividends, interest, and rent. I call them DIR. And we looked at them on the surface. We looked at withholding tax. There's a future topic that will cover these dividends, interest, and rent, where you will see them in more details. And there's a future topic that you will see withholding tax. Most of them are in skills level. So in the case of professional level here, we are going to be applying them. If we need not to broaden our knowledge, we'll go to skills level and borrow a lead there. So we have seen how these things are being done in questions. Look at one question for change of accounting date. So as we progresses in our lectures, you're going to be seeing how these things are being affected. In our next class, we are only going to be taking question on this topic. It's going to be a question on commencement and cessation mostly, because we have seen change of accounting date. But if there's time in the next class, we can still do one more in change of accounting date. So, and that will wrap up the class on this topic. So thank you so much for the fine participation in the class. If you have any question, please feel free to ask me on the WhatsApp group or in my WhatsApp. So,
Thank you.
so much. I do believe that you understood all that we've learned. Yeah,
Yeah. Thank you.
thank you. Keep
Bye.
coming wherever you are getting confused. You have a nice day. The recording
Yay.
will be available to you shortly.
Thank you.
You're welcome.